Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode, we're talking about the impact of tariffs on the banking industry. Since the news of universal and reciprocal tariffs surfaced on April 2nd, tariffs have spurred fears of an economic slowdown and dominated trading activity, particularly in bank stocks, which are highly cyclical. While reciprocal tariffs have been paused, much uncertainty remains. Bank earnings season kicked off in force not long after the tariff announcement, and we've tuned in closely to hear how management teams think tariffs could impact their businesses and the broader economy. Harry Terris is a senior reporter on our news team and has listened to many calls this earnings season. Harry's joined me on the show to talk about some of the takeaways from big bank earnings. Thanks for coming on the show, Harry. So, Harry, we're a couple weeks in the earnings. What have we heard from banks and their results, and what do they tell us about the impact of tariffs thus far?
Maybe it's a little unsatisfying, but broadly, I think we still have more questions than answers. We did get a lot of data and color on customer activity through mid-April or so. Big picture, I think the split between hard and soft data that existed going into earnings reports persists. That is, for example, credit earnings survey or conference data and securities market price volatility or stock prices that seems to anticipate a major rupture, if not a deep recession on the one hand, and then hard real-time data on the other hand, showing stuff like strength in consumer spending and finances. On the commercial side, banks generally said they didn't see line draws that would indicate stress, for example. That was a prominent dynamic early in the pandemic, which obviously involved a free fall in employment that was then quickly addressed with massive government support and the creation of vaccines really very quickly. Clearly, COVID isn't even necessarily the right model for whatever might happen next. That's sort of the problem, I think, is that folks are groping for analogs and there aren't any easy answers. The tariffs that have gone into effect are quite historic, even after the climb downs and accommodations and so forth. It's logical to expect a big impact, bigger than the tariffs in Trump 1.0, with inflation already elevated, creating a conundrum for the Federal Reserve and how it might respond. But as JPMorgan Chase's CFO observed, much of the salient news flow is quite recent. Tariffs haven't yet broadly, unmistakably, flowed through into vital economic measures like consumer prices. I would say there is something concrete in the stability of contemporaneous reads of customer activity. It's possible, for example, that a negative wealth effect from the decline in stock market prices might have already fed through somewhere in a big, unequivocal way. Banks have deep insight into consumer spending and have called out some signs of households maybe pulling forward spending in categories like electronics and cars to get ahead of tariffs, and likely pulling back on travel and entertainment spending. But fundamentally, the picture the banks gave was of abiding strength in spending to date. So the broad issue is just profound uncertainty. It's man-made uncertainty, which adds a sort of pesky dimension. Even if Trump was more predictable, it's possible courts would find the tariffs illegal, and then you'd be left trying to guess how Trump would react to that. So it's hard to fill in the blanks, I guess.
Right, but a couple things in there that I thought were really interesting. One, it's a little bit too early, right? Because Q1 results end in March. But one of the things I heard you say is that bank management teams, which are monitoring their customers on an ongoing basis, are still saying we're not really seeing cracks in the armor yet. So not only is it uncertain, but it's a little too early to tell what the impact would be.
Yeah. There is a lot of time devoted to bank executives giving their reads on like their customer spending data, particularly banks with big credit card operations, and trying to like sift through for early signs. But that's all we have at this point. Again, sort of these signals that are consonant with some major shifts, but in general, consumers showing continued resilience. The same bifurcation between confidence data and actual activity, which for a couple of years there has been a dissonance between those two.
Right, pretty incredible. The consumer continues to hold up, and that's really important too, because we are a consumer-driven economy. So if the consumer holds up and sits in the face of this, and there's a long belief that even if these tariffs are put in place, that's who might have to eat the cost. If we're not seeing that really lead the cracks yet, that should inspire some confidence. Maybe not an all clear signal or anything like that, but I felt like that's one of the things that management teams are trying to push out there in the face of the broad sell off that we had seen.
I mean, I think there's a lot of nervousness. I mean, I would assume that in general, if you're like would expect a lag, for this to show up in price data and in consumer prices, and then for that to impact sales and to like strain consumers and businesses and lead to layoffs. So there could very well be a long lag time, but guessing what that'll look like is very difficult, is very complicated, and almost impossible to do outside of research forecasts. But in terms of making conclusions that impact guidance, not so much just yet.
Yeah, I want to pick up on that because one of the things we've seen from the sell side is I feel like you haven't seen them change estimates all that much. You've seen estimates for things like investment banking fees, whether that's for M&A advisory or equity underwriting or debt underwriting, come down considerably. In fact, looking at our visible alpha estimates, you see they're down quite a bit since Liberation Day on April 2nd. But how about the companies themselves? What do we hear? Did we see guidance lowered from the big banks on some of the key things like net interest income, which really comes from making loans?
Yeah, no, there hasn't been much change at all in the guidance that banks are giving. I thought First Citizens in North Carolina was kind of pithy in their characterization of what they're doing, what they did with their guidance, which is they said that the fluidity of the situation makes it difficult to narrow the range of potential impacts, and so therefore they mostly left their 2025 guidance unchanged. JPMorgan Chase also pretty much stuck to its forecast for net interest income for the year, which had kind of been a question mark since they're asset sensitive and markets expect more rate cuts than they did before. Not that that's necessarily the interest rate path that will pan out. Bank of America also maintained its net interest income guidance. You have to caveat this. JPMorgan Chase says it generally doesn't provide guidance for things that is very hard to predict or completely out of its control. In addition to net interest income, its guidance staples are expenses and credit card net charge-offs. Card net charge-offs drive credit performance for JP Morgan across cycles. So one might take a steady guide for the year as a signal that that the bank is confident that things won't go south. But it can often take about a half a year for a card account to move from initial delinquency to charge-off. So that kind of steady forecast might not say that much. And a bunch of banks added weightings to downside scenarios or layered in qualitative factors into models they use to set loan loss reserves. That includes JP Morgan Chase, which boosted its reserves by about $1 billion with nearly half for card. That also includes Capital One in its domestic card business, although the net allowance for Capital One actually fell sequentially, reflecting good performance in its portfolio. And broadly, I would say the maybe more notable trend was lowered loan growth guidance by a number of banks, citing sort of more of the wait and see among clients. I don't think previous loan growth forecasts were necessarily that aggressive, though generally the shift in the quarter took some air out of hope for a rebound finally in loan growth.
Yeah, and we've been in that camp. Just the idea that wherever this ends up, uncertainty has to slow business investment, has to slow expansion plans, or at least put them kind of on hold. So even if it's just later down the road, that probably has to be lower loan growth than we would have expected otherwise.
Yeah, and some executives are pointing to hopes. I mean, it's certainly reasonable to expect more information to be filled in 3 months, but the sort of optimism that we'll get through the uncertainty quickly, I think there's a reason to be skeptical about that because it's really sort of a policy induced uncertainty, and so the expectation must be that the policy becomes stable, and I'm not sure what the basis is for that.
Right. And to that point, too, we not only need to know what the policy is, We then need to try to assess what the impact of that policy is, and we don't know the first part even yet.
Yeah, that's right. I mean, instantly erecting very strong, immediate trade barriers would provide certainty, but with quite devastating consequences.
Yeah, on that last front, what do we hear about the dreaded R word? You've heard folks in the markets talk about or worry about the prospect of a recession. I saw that Goldman even came out recently and putting the probability, I think, of 40 or even 45%. That's pretty darn high. What have we heard from the big banks? Are they entertaining that as a possibility, or are they preparing for tougher sledding ahead?
Yeah, I think most of the Wall Street banks, economic research analysts, their economists generally are either forecasting a slowdown or saying that a recession is more likely than not. That's not uncommon in the second half of the year. I don't think you hear like as explicit from bank executives in that kind of forecasting. But the reserve models incorporate that information, and so bank credit loss reserves do reflect that sort of pessimistic outlook.
Certainly. Thanks for those thoughts, Harry. Well, the impact of tariffs isn't just limited to banks' fundamental operations. Tariffs also have had a big impact on markets and M&A activity. Markets don't like uncertainty, and the prospect of tariffs has certainly created that. Even the pause in tariffs itself, no doubt, has found its way into many ongoing deal discussions. We've spoken regularly to deal advisors about the potential impact the tariffs could have on M&A discussions, and I've also paid close attention to what the sell-side community thinks tariffs could do to major banks' investment banking businesses. Much of that coverage has been led by our bank news team, which is led by Lauren Seay. Lauren's joining me here on the show as well. Lauren, we've covered this from a variety of angles. How have tariffs impacted the outlook for investment banking fees broadly?
Yeah, well, first of all, thank you for having me, Nathan. Like you said, the markets don't like uncertainty, and we've definitely seen that play through in bank stocks over the last couple weeks since April 2nd, Liberation Day. But even just broader, iBanking fees are expected to be down this year and take a pretty hard hit because M&A is on pause for a lot of industries. Visible Alpha data estimates that 2025 aggregate iBanking fees are going to be down 9.4% from their estimates just on March 31st. And even the week prior, that estimate was just down 5%. So, I mean, just 1 week, you can see how big of a difference that makes with how the markets are moving and people are going on pause. 2026, it's supposed to be extended into the next year as well. 2026 fees are estimated to be down 4.5% from March 31st estimates. And I think Texas Capital execs put it well on their earnings call. They said uncertainty is the killer of all deals when they were talking about their iBanking business. They said that they lost single digit millions in iBanking fees that they don't expect to get back in the past couple weeks.
Those are pretty material moves. I mean, down 9% off of a big base when we're talking about behemoths like JPM and Goldman and Morgan Stanley and the likes of that. And I think your point, too, about the week-to-week, down 9% a few weeks in to the post-tariff announcement versus just down 5% in the first week, it almost sort of shows that the sell side was hoping that maybe this wasn't going to last as long or be as bad as we thought, and that the uncertainty continuing is starting to show up in some real results. We've definitely seen in Bankland, and I know we spent a lot more time there, and you do as well. What have we heard from the bank deal advisor community? We had thought coming this year that friendlier regulatory environment would lead to much more activity, big rebound off of the slowdown we saw the last few years. But has Liberation Day really threatened that resurgence?
Yeah, tariffs and the prospect of tariffs have definitely threatened a resurgence. It kind of feels a little silly to say considering we just saw the two largest deals so far this year announced in the past 2 days, one of which is the largest deal since 2021. But overall activity has been really muted, and that was not the expectation in November, even coming into the year. Like you said, people were very excited for deregulation, faster closing timelines, a slightly more attractive rate environment. all of that leading to be able to get deals done a little easier. But we've not seen that play out even before Liberation Day, but certainly since we've seen pretty muted activity in April so far. We talked a lot to deal advisors who have told us that conversations that were happening have largely halted. They're not completely full stop done, but people are just pumping the brakes, taking a pause, taking a let's wait and see kind of posture because there's so much uncertainty. Now, there are some instances where there's like a unique deal or that can get done, or maybe it's an all cash deal that can get done because a buyer's, currency is their stock and it's hard to get things done when you have such a large sell-off. So we've seen some things able to get through, but ultimately it is a pause, and that's what we're hearing from advisors. Our deal reporter, Audrey Ellsbury, she did a great story right after Liberation Day that talking to bank deal advisors, and they compared this to recent black swan events, which it's crazy how many we've seen in the past 5 years with COVID and then the failures in 2023 and now this. It's all weird that it's all happened around March. A little spooky there.
The dreaded
Yeah.
March, the dreaded March chill.
But they compared it to those recent black swan events like COVID and the bank failures, the just unprecedented uncertainty. People are pausing and they're in wait and see mode. And in addition to deals that, we don't know about that were just in the works being on pause, this could even impact deals that have already been announced. They're unlikely to fall apart because, they still strategically make sense. There's high termination fees, but, these deal values have taken a hit. We just did a story on that, and the 20 largest pending bank deals values fell by a median of 13.9% as of April 8th. Some of those deals are even north of 20% following the sell-offs that we saw after Liberation Day. And we just did another story where iBankers are saying don't panic, but those valuations are fluctuating, and that causes concern, especially for shareholders. One advisor told Audrey that shareholder approval of these deals could be a bit rockier since these shareholders are seeing a lower nominal valuation.
Sure, you hit the bid because you thought you were worth 100 million, and 2 weeks later you're now worth 80. Or do you really think you're worth 80? Do you really want to take the plunge and give up your independence for that kind of delta? It could make some sense just given the comparison to those two black swan events, both COVID and the liquidity crunch that erupted after the regional bank failures. True exogenous risk and tariffs we haven't seen since the Great Depression could be that. What have we seen in terms of capital raising, or not even seen? What have we heard on the capital raising front in IPOs? Has it been a similar story that we've heard from the advisory community?
Yeah, I think both of those are likely on hold for now too. We've heard from advisors. The investment community just ties banks' performance with the economic cycle, and that's just what it is. Whether or not the economic cycle is really going to play out, whether or not banks are in a strong position prior to a downturn, that's just how it is. And these stock prices have really taken large hits this month, and we have seen some recovery, but until there's an improvement in sentiment and valuations, I think IPOs, capital raises, M&A, anything growth initiative related is likely on pause for now until people have more certainty. And just even going back to comparing this recent event to things we've seen in the last few years like COVID and the failures in March 2023, it's just unprecedented. There's a lot of volatility and a lot of uncertainty. And one advisor told Audrey that in both of those cases, COVID and the 23 failures, it took about a year for markets to recover. And he thinks that could be the case here too.
Wow. We're in the middle of earnings season, as Harry and I had discussed earlier. What have we heard from would-be buyers on earnings calls? M&A is always a topic that comes up, and no doubt it came up again this quarter.
Lots of M&A chatter, like you said, as usual. It's been really a mixed bag, which I thought is interesting because, like we just talked about, advisors have said, pretty much everything's on pause. And we've had banks saying that it's impossible to do deals right now. Like PNC's CEO said, it's impossible to do M&A right now. PNC would not issue their shares at their current price. We also had Comerica CEO and United Community Bank CEOs both said that it could take 12 to 18 months for M&A to return, which I thought was interesting that they both had that longer view, kind of like the advisor that Audrey talked to. But then we had others that are still pretty confident that they can get stuff done and think that they're sellers that are sophisticated enough to see past where we're at and know that it's just a slump and things will go back up. Prosperity said that, they're saving their cash for M&A while buybacks are attractive right now. Given where stock prices are, they'd rather wait and find a seller that can, their CEO said, get over the psychology of it all. And they think they can find someone. The CEO said, we've in the past 3 years, our stock price has been as low as $50, as high as 85. And these banks that we would want to buy, they know us, and they know that if they take our stock price where it is now, which I think is around $67 last I looked, they know they'll be fine. That's some interesting commentary there. We also had Equity, who just struck a deal, I think right before the Liberation Day announcement, said they want to strike two more deals this year. I was interested to listen to their earnings call and see if they still have that outlook post Liberation Day, and they said they do. They still want to strike another deal or two, and that it actually can be more attractive to take a buyer's stock when it's lower like this and ride it higher. Redo that and ride it higher. So, it was really a mixed bag, but maybe those that are more bullish on the M&A environment were onto something, because we just saw the Columbia and Eastern deals in the last 2 days, the two largest deals we've seen so far this year.
Certainly. And those two buyers you point to, David Zalman and Prosperity, been one of the most active acquirers you've seen in the banking space over the last 20 years, certainly known as an acquirer, and Equity as well, and in more recent years. And that's an interesting comment about hoping to do a couple of deals. We had heard Home talk a little bit about that as well. And the idea that goes back to where we were 3 months ago, the idea that maybe we could get swifter regulatory approval and see a couple deals done in a year. And that was one of the things kind of fostering this idea that maybe we could see a pickup this year in activity. We have seen that, right? I mean, it seems like there's still some hope. Maybe that's one of the still positive things. You can't necessarily ignore the economic side completely, but it feels like the banking community still has some faith, at least in that piece, that they might get more regulatory support. Do you agree?
Yeah. Yeah, definitely. There's definitely a lot of hope. We've seen that playing out both anecdotally in the data that we've pulled and in recent deal announcements. I think banks are really chomping at the bit to do M&A, and a lot of it has to do with they know they can get things done faster and they can get more than one thing done at a time, because that was something we heard under the Biden administration is you can really only do one deal within, I think it was like a year they were saying, or at a time. So banks are ready to strike, and they like this regulatory environment once we get past this uncertainty. Anecdotally, we've already seen it. Cadence got approval of their acquisition of FCB Financial in just 61 days. We've seen a lot of people talking about that. And you mentioned home bank shares. Johnny Allison referenced that 61-day regulatory timeline, saying that I'm excited that I can get a deal approved in 60 days. That's really exciting. And we've already seen that in the data too. I mean, it's only a couple months into this administration, but we put together a chart for a story that we did on this topic about, is this already playing out? And it is. Deals with a value below 50 million, and then those with a value above 500 million that have closed this year are seeing the fastest closing timelines than they've seen in 4 years. So it's a favorable regulatory environment, and I can't remember which bank said this on their earnings call, but they said, there is uncertainty right now, but you can't wait too long. Like if you wait till this uncertainty is gone, I mean, you only have this window. You don't know who the next administration's going to be, so people are wanting to get deals done now. And you're also seeing it play out in deals that have been announced recently, a lot shorter closing timeframe estimates than we've seen in the last 4 years. Like Columbia expects to close the Pacific Premier deal this year, and it took over a year and a half for the Umpqua deal to close. Now there are some differences there, like the DOJ isn't involved in the Pacific Premier deal, but that just really shows how optimistic these banks are about regulatory prospects when it comes to M&A. We also saw the Capital One Discover deal close with some hefty fines and a consent order. And, it's speculative, but you have to wonder if that deal would have secured regulatory approval at this point if the Trump admin wasn't in office.
Certainly unusual to see a a billion plus fine and get a deal closed in the same beat. That does seem like a pretty big sea change. And to your point, too, about this window being open, it's not even just the window of the policy and regulatory framework. That's a very good point. But two, if you've got a favorite target, are they still going to be around? So it feels like we got a little bit of tailwind there, and a definite wait and see, though from the threat to potential threat to the economy from tariffs. So a little bit of good and bad.
Yeah, definitely. I think there's a lot of tailwinds and people, like I said, are chomping at the bit. We just have this headwind of tariffs and the economic outlook. And if people can get past that, or if we get some certainty, deals can get done.
Well, terrific. Well, thank you, Lauren, for coming on the show. Appreciate it.
Yeah, thank you so much, Nathan.